In 2021, a team of journalists at ProPublica obtained the actual tax records of America's 25 wealthiest individuals, and the number they came back with was so striking that it immediately became one of the most debated financial stories of the decade. Those 25 people, with a combined net worth measured in the trillions, paid what ProPublica called a true tax rate of 3.4% on their total wealth growth between 2014 and 2018. 3.4. Not their official rate on taxable income. The rate calculated by dividing the taxes they actually paid by the actual growth of their actual wealth. The average American worker in that same period paid an effective federal rate on wages somewhere between 13 and 22%. The wealth was real, the taxes were legal, and the gap between those two numbers is what this video is about. Warren Buffett walked into a congressional roundtable in 2011 and said something that most people remember as a political statement, but is actually a financial one. He told the committee, unprompted, that he pays a lower effective tax rate than his own secretary. He had the receipts. His secretary, Debbie Bossanek, sat next to the First Lady at the State of the Union address the following year, specifically because Buffett put her story on record. His effective rate that year was approximately 17%. Hers was approximately 36%. The difference had nothing to do with how hard either of them worked or how much either of them earned. The difference was in the type of income. He earns from assets. She earns from a salary. The tax code does not treat those two things the same. This is not a complaint, and it is not political commentary. Buffett himself has publicly called for higher taxes on billionaires for decades, and he still pays 17% because 17% is what the law requires him to pay. The point of this video is simpler than politics. The tax code is not one system. It is two systems layered on top of each other. One written for income that comes from your labor, and one written for income that comes from your assets. Once you understand how each system works, two things become clear. First, why the gap in the numbers exists. Second, what is already inside the code, legally and intentionally, that allows ordinary workers to shift more of their wealth building to the lower tax side of that line. The gap in the tax code did not appear overnight. It was built through decades of legislation, each piece of which was justified to Congress with the same basic argument. Taxing investment income too aggressively discourages investment, and investment drives job creation and economic growth. The argument has been made repeatedly by both parties since the capital gains tax was first introduced in 1921. The rate on long-term gains has moved up and down over the decades, but the critical shift came in 2003 when the Jobs and Growth Tax Relief Reconciliation Act cut the top long-term capital gains rate from 20% to 15%. That rate was later extended and made largely permanent. The structure that the average American worker lives inside today, where wages face one set of rules and capital income faces another, more favorable set, has been the legal landscape for long enough that most people do not know it was ever any different. If money has ever felt like a system working against you, subscribe to this channel. This is where we break down how the financial machine actually works, the lessons they never taught you in school. Here is the comparison with actual numbers, so you can see exactly what this means. A person earning $100,000 a year in wages in 2024 pays federal income tax at graduated rates. After the standard deduction of $14,600, the federal tax on the remaining $85,400 is approximately $15,000. Then Social Security takes $6,200. Medicare takes $1,450. Total federal obligation, more than $22,000, roughly 22% of gross income, taken before you make a single financial decision. A person who earned $100,000 from selling stock they had held for more than 1 year pays federal long-term capital gains tax at 15%, no Social Security, no Medicare. Their total federal obligation, $15,000, $7,000 less, on the same amount of money, in the same year, under the same government. The wage penalty goes deeper than most people realize when they look at a pay stub. Social Security is not optional. It is taken at 6.2% of every dollar of wage income up to $168,000, automatically before the money reaches you. Medicare is another 1.45% of every dollar. These taxes do not apply to capital gains. They do not apply to dividends. They do not apply to investment income of any kind. They are levied exclusively on wages and salaries, on the income you earn by showing up, doing the work, and getting paid. A teacher earning $60,000 a year contributes nearly $4,000 per year in Social Security tax alone, just by being employed. A retiree who earns $60,000 a year selling appreciated stock pays zero Social Security tax. Not reduced. Zero. Why did Congress write it this way? The answer that has been given consistently for a century is economic incentive. The argument is that capital investment, putting money into businesses, assets, and productive resources for long periods of time, is harder to sustain if the government taxes the returns at the same rate as wages. When you earn wages, the money arrives and the tax is taken. When you invest capital, you accept risk for years, sometimes decades, before you see a return. The lower capital gains rate is a deliberate reward for accepting that risk and locking up money productively for long periods. Whether the current calibration, 15% on capital gains against 22 to 37% on wages, is the right calibration is a policy debate. The mechanics themselves are not debatable. They are simply how the code is written. Pay attention to this next part, because this is where the two systems stop being abstract and become real money. Two people, both earning $150,000 this year. One earns it from wages, a salary, a bonus, income reported on a W-2. Their total federal tax, including income tax, Social Security, and Medicare, is approximately $32,000. The other earned $150,000 from selling index fund shares they had held for more than a year. Their total federal tax is $22,500. No Social Security, no Medicare, just long-term capital gains at 15%. A $10,000 difference in a single year on identical incomes. The only variable is the column on the tax form. Whether the income reads wages or capital gains is what determines the difference. And the $10,000 annual gap, invested for 30 years at 10%, becomes $174,000. The same amount of money. Two completely different conversations with the tax code. If you recognize this gap in your own finances, if something about the pay stub never quite added up, write in the comments, "I am learning the code." Understanding how the machine works is the first step to using it. Now look at what Buffett actually does with his money, because this is where the mechanics become specific. Berkshire Hathaway pays Buffett $100,000 a year in salary. That salary is taxed at ordinary income rates, the same rates that apply to your wages. But his net worth is approximately $130 billion. The overwhelming majority of that is Berkshire Hathaway stock. Stock he has accumulated and held for 60 years. He does not sell it. And because he does not sell it, no tax event occurs. Every year the stock grows in value. Every year he becomes wealthier. Every year zero capital gains tax is owed, because zero shares have been sold. This is the part most people find surprising when they hear it for the first time. Growth in the value of an asset is not income, not legally, not until you sell. If you buy 100 shares of a company and those shares triple in value over 10 years, you are significantly wealthier. But in the eyes of the tax code, no taxable event has occurred. The gain is unrealized. Buffett's Berkshire shares have a cost basis, what he originally paid, that is a tiny fraction of what those shares are worth today. The distance between those two numbers represents hundreds of billions of dollars. None of it has ever been taxed. And if those shares are never sold during his lifetime, it never will be, because of a provision in the tax code called the step-up in basis. When Buffett needs cash for living expenses, charitable giving, or any other purpose, he does not have to sell stock. He can borrow money from a bank using his Berkshire shares as collateral. A loan is not income. A loan is not a taxable event. He receives the cash, he pays interest on the loan, which may itself be tax-deductible as an investment expense. He keeps full ownership of his stock, which continues to appreciate. He has liquidity without triggering a capital gains bill. Tax attorneys have a name for the broader strategy that this is a part of. Buy, borrow, die. Buy appreciating assets. Borrow against them when you need cash rather than selling. Hold until you die. The name sounds grim. The tax math is exact. The die part is not metaphor. At death, the tax code applies what is called a step-up in basis to inherited assets. Here is how that works in plain language. Say Buffett originally purchased Berkshire shares at an effective cost of $10 per share, and those shares are worth $600,000 per share when he dies. His heirs inherit those shares at the current market price, $600,000, not at the original cost of $10. The entire gain between those two numbers, accumulated over a lifetime of compounding, is simply forgiven by the tax code. His heirs can sell those shares immediately and owe zero capital gains tax on 60 years of appreciation. The step-up in basis is not a loophole someone invented. It is a written provision of the Internal Revenue Code, applied as Congress intended. One more layer. Berkshire Hathaway has paid one dividend in its entire history, a 10-cent dividend, in 1967. Buffett has joked that he must have been in the bathroom when the board approved it, because it has never been repeated. This is not an accident. When a company pays a dividend, shareholders receive that cash as taxable income in the year it is paid, regardless of whether they wanted the distribution or would prefer the company reinvest the money. By retaining all earnings inside Berkshire and reinvesting them into new acquisitions and assets, Buffett ensures that the wealth of Berkshire shareholders grows year after year without triggering annual taxable income. The value accumulates as stock appreciation, unrealized, untaxed, compounding until the shareholder chooses to sell, which in Buffett's case is never. If this is making the picture clearer, let me know by liking this video. It tells me this content is doing its job. Your paycheck tells a different story than Buffett's portfolio, and here is exactly what that story costs you. Take a gross salary of $75,000 a year. With the 2024 standard deduction of $14,600 for a single filer, your federal taxable income is approximately $60,400. Your federal income tax on that amount is roughly $8,900. Social Security takes $4,650 on the full $75,000. Medicare takes $1,088. Total federal obligation, approximately $14,638 before a single financial decision is made. That is 19.5% of your gross pay gone automatically, with no way to reduce it at the source, no choice about timing, and no delay between when the money arrives and when the government takes its share. Now look at the same $75,000 arriving as long-term capital gains, stock you purchased several years ago that you have now sold at a profit of $75,000. With the same standard deduction applied, your federal capital gains tax is approximately $11,250. Zero Social Security, zero Medicare. $11,250 instead of $14,638. Over $3,000 less in the same year on the same dollar amount, simply because the income was earned through an asset rather than through labor. And at lower income levels, the gap is even larger. If your total taxable income falls below approximately $47,000 as a single filer, the federal capital gains tax rate is not 15%. It is zero. As income rises, the advantage of capital income over wage income compounds further. Someone earning $250,000 in salary faces a federal marginal income tax rate of 32 to 35% on the upper portion, plus Medicare surcharges above $200,000, plus Social Security on the first $168,000. Someone earning $250,000 in long-term capital gains faces a federal rate capped at 20%, no Social Security, a reduced Medicare obligation. The difference in total taxes paid between those two scenarios on the same gross income can exceed $40,000 in a single year, not because of anything either person did wrong, because of which side of the two-system tax code their income landed on. You are probably thinking, I do not have Berkshire stock. I do not borrow against assets. The buy, borrow, die strategy requires wealth I do not have yet. And none of this changes what I owe on my salary next April. That objection is valid. Buffett's specific situation, $100 billion stake in a company he has controlled for 60 years, is not replicable for a person earning $70,000 a year. But the principle underneath his tax math is replicable, and the federal tax code already has the tools to apply that principle at any income level. The goal is not to eliminate wage income tax on the money you earn today. The goal is to shift more of your long-term wealth building, the money that will grow for decades, out of the highest tax column and into the lower tax or no tax column. The moment you contribute to a 401k, something important happens that most people who do it do not fully understand. The money you contribute, before it goes into the account, was going to be taxed at your full marginal rate. At a 22% bracket, a $10,000 contribution would have produced $2,200 in federal income tax. By routing it into the 401k first, that tax does not happen this year. The $2,200 stays in the account, compounding instead of going to the IRS. You have not eliminated the tax. You will pay tax on this money when you withdraw it in retirement. But you have done what Buffett does with Berkshire stock. You have deferred the taxable event, kept the full principal working, and gained decades of compounding on money that would otherwise have been reduced before it was ever invested. If you have been trying to close the gap between the theory of wealth building and the actual movement of your finances, if the math makes sense but the account does not reflect it, check the first pinned comment below this video. It is there for people who are ready to stop understanding the problem and start changing it. The 401k was created by Congress in 1978, and in 2024, an employee can contribute up to $23,000 annually, $30,500 if they are 50 or older. Contributions reduce federal taxable income in the year they are made. Contribute $23,000 in a 22% bracket, and your federal tax bill drops by $5,060 in that year alone. The money inside the account grows without annual taxation on dividends, interest, or capital gains. When you retire and withdraw, you pay ordinary income tax at whatever rate applies to your income then, which for most people is lower than during their working years. The 401k does not make you rich by itself, but it changes the tax math on every dollar you put into it from the year you start. One piece of the 401k that deserves its own attention is the employer match. Most companies that offer a 401k will match some portion of what you contribute, typically 50 cents for every dollar up to 6% of salary, or sometimes a full dollar-for-dollar match up to a set percentage. On a $60,000 salary, contributing just $3,000 to capture a full 3% match means your employer deposits another $1,800 into your account. Before a single dollar has grown through the market, that contribution is already 60% ahead. No stock, no bond, no index fund offers a guaranteed 60% return the moment you make it. Contributing enough to capture the full match before any other financial priority is the one decision in personal finance that has no legitimate counter-argument, regardless of your income level, your debt situation, or where the market is today. The Roth IRA works differently, and understanding the difference matters. With a traditional IRA or 401k, contributions are pre-tax. They reduce your income today, but withdrawals are taxed. With a Roth, you contribute money that has already been taxed. No deduction today, but every dollar inside the account grows completely tax-free. The gains, the dividends, the compound growth over 30 years, all of it comes out in retirement with zero federal income tax owed. $7,000 a year contributed to a Roth IRA from age 25 to 65, growing at 10% annually, produces approximately $3.5 million at retirement, and every dollar of that $3.5 million comes out without a tax bill. The government taxed the seed, the harvest is yours. For someone who expects their income to rise over time, or who simply wants certainty about their future tax burden, the Roth is the closest most workers will ever get to Buffett's zero tax compounding. The Health Savings Account, the HSA, is the only account in the entire federal tax code that offers what financial planners call a triple tax advantage. Contributions are pre-tax, reducing taxable income the year you contribute. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are also tax-free, all three. Simultaneously, no other account structure does that. In 2024, you can contribute $4,150 as an individual or $8,300 as a family. After age 65, the HSA functions like a traditional IRA for non-medical expenses. Withdrawals become taxable, but the same rules apply as any retirement account. For the medical costs that represent one of the largest spending categories in retirement, the account remains tax-free permanently. Most people either do not know about the triple advantage or do not have a high-deductible health plan that qualifies. But for those who do, it is the most tax-efficient account available. Once you have the account set up, the next question is what goes inside each one, and most people have never been told that it matters. Financial planners call it asset location, placing your most tax-inefficient investments inside your most tax-protected accounts. Bonds generate interest taxed as ordinary income every year. High-dividend stocks pay distributions taxed annually. REITs are required by law to distribute most of their income as taxable dividends. All of these belong inside a 401k or traditional IRA, where annual distributions do not create a tax bill. Growth-oriented index funds, meanwhile, generate minimal taxable distributions and lose little to tax drag when held in a regular brokerage account. The money is the same. The investments are the same. Placed in the right accounts, the after-tax result over 30 years is materially different. And the only thing that changes is which account holds which asset. Here is something that almost nobody discusses because it sounds too good to be real: the 0% long-term capital gains bracket. In 2024, if your total taxable income after deductions is below approximately $47,000 as a single filer or $94,000 for a married couple, Your federal tax rate on long-term capital gains is 0. Not reduced, not lower, 0. A worker in a low-income year. A recent retiree managing their withdrawal rate carefully. Someone who has structured their income to fall within this threshold. All of them can sell appreciated stock and pay no federal capital gains tax at all. This bracket was not designed for billionaires. Billionaires earn far too much to qualify. It was designed for ordinary investors, and the majority of ordinary investors have never heard of it. Tax loss harvesting is a strategy that sounds complex, but is actually straightforward once you understand what it does. If you own investments that are currently worth less than what you paid for them, you can sell those positions deliberately, realize the loss on paper, and use that loss to offset taxable gains elsewhere in your portfolio. If you have a $5,000 gain on one investment and a $3,000 loss on another, harvesting the loss reduces your net taxable gain to $2,000. The IRS has a wash sale rule that prevents you from buying back the same security within 30 days, but you can immediately buy a substantially similar investment, maintaining your market exposure while banking the tax benefit. Many robo-advisors and index fund platforms offer this automatically at no additional cost to any investor with a taxable account. One of the most practical rules in the entire tax code is also one of the least discussed, the 12-month threshold. Sell an investment before 1 year and any gain is taxed as ordinary income, the same rate that applies to your wages. Hold it for 1 year and 1 day, and that same gain qualifies for long-term capital gains rates, 15% for most earners, 0 for lower-income investors. The difference between selling at 11 months and selling at 13 months can be 15 to 20 percentage points on the same dollar of profit. On a $20,000 gain, that gap is $3,000 to $4,000, not from making a better investment or calling the market correctly, but from understanding and applying a rule that is written explicitly into the code. Patience has a dollar value. In this case, the minimum patience required is 12 months. Index funds earn their reputation in personal finance for many reasons, but one of the least discussed is tax efficiency. An actively managed mutual fund buys and sells positions constantly as the fund manager adjusts the portfolio. Each sale inside the fund creates a capital gains distribution that flows through to every shareholder, even if that shareholder personally sold nothing and made no decision. An index fund only trades when the composition of the index itself changes, which happens rarely. The result is minimal taxable distributions and minimal drag on compound growth over time. Buffett recommends low-cost S&P 500 index funds explicitly in his shareholder letters and in the instructions he has left for his family's inheritance. Part of the reason is expense ratios. Part of the reason is that index funds rarely force their owners into taxable events. Every year you hold an investment instead of selling it, something tax-specific happens. The tax event does not occur. The full amount, including what would have been owed in taxes, continues to compound. Someone who bought $10,000 of an index fund 20 years ago and held it has a much larger account today than someone who traded actively and paid 15% on realized gains along the way. Not because the buy-and-hold investor was smarter, because they kept more principal compounding more continuously. Buffett's single most repeated observation about investing, that his favorite holding period is forever, is not only about patience and business quality, it is also a tax strategy. Every year of deferral is a year the full principal works instead of a reduced principal after taxes. Hold, do not sell. Use the right accounts. Let the compound run without interruption. The Billionaires' tax strategy in 4 sentences. At their scale, the specific tools are borrowed cash against collateral and the step-up in basis. At your scale, the tools are 401k, Roth, HSA, and holding periods longer than 1 year. The principle underneath all of it is identical. Buffett has told the city's service story hundreds of times because the lesson stays with him. At 11 years old in 1942, he bought 3 shares of City's Service Preferred stock at $38.25 per share. The stock fell to $27. He held. It came back to $40. He sold. He made a small profit and paid the tax on it. Then he watched City's Service climb past $200 per share. He described the experience later as one of the most important lessons of his investing life, not because of the amount of money involved, but because of what it demonstrated simultaneously. Selling too early ends the compounding, and selling early triggers a taxable event that permanently removes capital from the machine. Every share sold is a tax event. Every tax event reduces the principal available to compound. The lesson is about patience. Yes, it is also about taxes. What does all of this look like for a real person earning $70,000 a year? They contribute $15,000 to their 401k, reducing federal taxable income immediately. They contribute $7,000 to a Roth IRA. Their employer matches 5% of salary, adding $3,500 more to the 401k. They invest all of it in low-cost index funds and do not sell. Their annual tax bill is lower. Their wealth is building in accounts where growth will not be taxed annually, where capital gains rates will apply at withdrawal or no taxes will apply at all. After 30 years at 10% average annual return, the total across both accounts is approximately $4,200,000, not a billionaire outcome, but a retirement built on the same principle Buffett has applied since he was 11 years old. Keep the capital working, minimize the taxable events, let time do its job. The tax code is not neutral. It has never been neutral. It was written by people who understood it, revised by people who understood it, and it consistently rewards the patient over the active, the asset owner over the wage earner, the person who holds over the person who sells. That is real, and knowing it should change something about how you build. Because if the code rewards assets, start building assets. If it rewards holding, hold. If it charges most for wage income taxed immediately, shift as much of your long-term building as possible to the accounts that operate on different rules. The game is tilted. The rules are the same for everyone. The people who know the rules play differently than the people who do not. Buffett has said in multiple letters to shareholders that the best tax planning he ever did was simply refusing to sell. Holding Coca-Cola since 1988, with a position now worth over $20 billion and a cost basis of $1.3 billion. Holding Apple for years without a meaningful reduction. Holding Berkshire itself since the 1960s, a stake now worth more than the entire market capitalization of most Fortune 500 companies, bought at fractions of a cent per share equivalent. Every year of holding is a year the tax bill is deferred. Every deferred year is a year the full principal compounds without interruption. The patience is not just a virtue about investing, it is a tax act, and it is available to anyone willing to leave assets alone and let time run. Your job is not to rewrite the code. Your job is to understand it, work within it, and use the tools inside it that are already open to you. A 401k that reduces your taxable income this year, a Roth that eliminates taxes on decades of compounding, an index fund that holds without triggering taxable events, a holding period over 1 year that converts your gains from ordinary income rates to capital gains rates. A 0% capital gains bracket that applies if you manage your income carefully. These are not workarounds. They are the code as written, used as intended. Buffett built one of the largest fortunes in history on the principle of letting capital work without unnecessary interruption. You will not build what he built, but you can build something real and pay significantly less in taxes doing it. If you made it to the end of this video, write in the comments, I am learning both languages. There is another video on your screen right now, the next piece of the financial picture. Thank you for watching, and we will see you in the next one.